Greetings, Jonathan Camarda, Chief Investment Officer. Let's get to it. A lot to cover here. The market continues to climb a wall of worry. Generally, historically, like we said, the back half of March is pretty bullish versus the front half of March. Of course, this year we had some more volatility with the banking crisis there, with the SVB and Signature situations. Market, however, has recovered. Tech stocks leading away with rates dropping across the board. Now, there's a lot of things to look at as, again, the recessionary winds are out there. As you continue, we've been talking about this since last year when the large tech companies were laying off thousands. Now, again, some of your more value type stocks are doing so as well. That is not economic growth friendly. And if you look at some of the data late last week and early this morning, April 3rd here, again, weaker than expected. Now, there is a, and the point I'll make on that is if you look at a company like McDonald's, I usually don't mention individual stocks, but I'm mentioning McDonald's because they are actually shutting their office down this week to actually, to send out notices, I guess. It's very interesting. Never heard of that before. They're going to shut them down and thousands will be laid off. We'll find out the details, I guess, later this week. That is not generally economic expansive moves. Okay, just if the Fed's listening there. And anyway, so now beyond that, I did want to also get to over the weekend, contrary to that, of the decreasing rates that we've seen with more of a recessionary backdrop, is that we have commodity prices and oil, especially going up with the Saudis cutting production. But that is more of an outlier, okay? Saudis cutting production, we won't get into the U.S. reserve or oil situation where we've been, again, selling those off. And now, will we have to buy some back more expensively? We don't know. There's also talks, again, of China and Brazil, looking at a deal, again, just to weaken that petrodollar. I'm not going to go too global macro. You can do some of your own research. That's out there. You're not hearing on the news, but the news is out there if you go look at it. Again, what will that mean for energy prices here? Probably not too promising if the dollar does not remain as the reserve currency for the oil markets. Now, with that little bit of gloom aside, the markets in April, pre-election, essentially over 88 to 94% across the board, respectively, on the three major indices, your S&P, Dow, and NASDAQ, probability-wise, up. First couple of weeks, especially just like the back couple of weeks of March, generally bullish. And we've seen that, right? And the aforementioned AAII, right? We're talking about the American Association of Individual Investor Sentiment. 71 straight weeks, it's been below the historic average of bullishness. And as that has dropped in sentiment, the market's gone up, right? We talked about the contrary indicator as a lot of the large money has been participating to the upside, but a lot of individual investors have been heavy on cash. How heavy, you ask? Well, it's not all individual investors. They can't do it all. But listen to this. In COVID, post-COVID, May of 20, okay, cash was 3.2 trillion, right? Oh, I can't beat that, right? It has been clocked at 5.2 trillion, right in that little melded area. That's 2 trillion higher than it was post the pandemic. That's a lot of money sitting on the sidelines. So when the market continues to gain steam, will that money participate in the catch-up trade? That can sometimes create a self-fulfilling prophecy. Now, not all bullish. We do have some headwinds. Obviously, when you look at earnings, a lot of prognosticators out there saying, well, we're going to start to look at reduced earnings projections, right? What they call forward guidance. So we shall see. But we've been hearing some of this news since late last year, and the market, again, has responded positively. Another note, speaking of late last year, is that, when the market does not drop below in the new year, it's December lows. That is a positive for the year, and it has not. Came close, didn't broach it. That is a positive right now. Now, we shall see, though, earnings this month, right? Let's lace them up, see what these companies say, and will that be a dour note to go along with what the Fed does as we roll through April into May? But here's the deal. The Fed's got to be paying attention to this. Some of the weak economic data late last week, and then early this morning, again, April 3rd, some weaker data. I can't fathom, and folks smarter than myself that have been gleaning since 5 a.m. this morning agree that just oil going up here on an outlier Saudi production cut is not inflationary. In fact, it could be disinflationary as lower income households that spend more of their money on food and energy could spend less elsewhere, which could be recessionary. All right, if your head's spinning, that's fine. Let's get to strategies from that standpoint. So I don't want to, again, when I say fine, that's fine to just cut it off there, but there's a lot in the air. And if you're feeling confused, you're not alone. So again, I'm saying that in a sense that we've never really had a washing machine environment like this that most can recall in the last 4 decades. What does it mean for strategies? Well, global macro, tactical, and velocity raptor have been increasing risk assets since the early March banking situation. Opportunistic growth and income stayed fully loaded and aggressive. That's the dividend strategy right through that and has been for the last couple of months. Now on your ETF tactical strategies that are based more on algorithms, sector momentum, again, got heavily exposed into equities early last week, participating on the back half of the week, while macro momentum still taking advantage of those plus 4% Treasury obligation Federal Reserve Schwab yields. However, the caveat again is as rates drop, and there are many that project with the weakness that we've seen that the 10-year could go to 2.5%, 3.5%. Remember those money market funds, the reason why you hire folks like ourselves is that's a short-term position for your money. When rates drop, you need to find other homes for it, and that could either be fixed income or risk assets. We shall see, but macro momentum still nesting in that area is the only strategy with a heavy percentage, in that plus 4% yielding account. Active capital preservation, the very conservative strategy. Again, all year long, been taking advantage of, lower rates with fixed income, as well as increasing some equity exposure to the most it can as a conservative strategy, but as well as getting on that gold train, right? As the dollar's been weak, right? Rates have come down, right? You guys understand the 3D chessboard. Dollar down, and then rates, have been down. Gold has been going up. So gold is almost the anti-inflationary metal. You always heard, oh, it's inflationary. Those rules have been changed. That script has been flipped years ago, and gold is actually going up as rates drop, which makes sense, right? Because there's less competition. Gold doesn't yield anything, so gold actually doing well in that environment. And so we're watching all of that, and just a lot of different factors to watch. So in summary, again, the weakest part of the market has been small caps. And many of you out there, many of you smart folks out there say, yeah, but small caps are a forward-looking indicator as far as aggressiveness. They should be outperforming large caps. Well, 2 caveats to that. Remember the small cap Russell 2000 index, very heavy in regional banks. Don't need to say any further than that. That's been a dampener. So that kind of, really takes that number out of the equation, as well as, again, a weaker dollar. Large cap companies can sell more of their goods, right, overseas, from that standpoint, as we've had more of that risk-off trade where some of the smart money was in the yen, out of the dollar, shorting, and as such, won't go too deep into Forex. So with that being said, here we are with the Fed on deck the next few weeks, and many think that their last hike will be the last hike. I'm not calling that. They may have another 25 basis points, but many smart economists, as you start to listen, smarter than this guy, saying that as we go to the latter part of the year, they will be forced to cut rates. Now, you're saying, well, that's a hard landing, bad for stocks. However, that may be portending of a weaker environment. But remember, the markets are always looking 6 to 9 months in advance, and lower rates, we've seen what they've done for tech companies, that can still be very bullish for the market. A lot to go through, a lot of gray area, but we'll stay on top of it as we are spinning plates. We never forget that, and your families, and we appreciate your time. As always, your patience and your trust. Stay frosty, and I'm going to try to cool off a little bit.